capitalisation relates to entities with cross-border investments claiming debt deductions against their Australian assessable income. US Co operates a business through a local Australian branch that has prepared its financial statements for the financial year. A summarised balance sheet shows the Australian property and plant assets and associated Australian liabilities. Interest expense for the current tax year on the bank loan was $3 million. To determine if thin capitalisation applies, we need to firstly establish that this is a cross-border investment and consider the maximum allowable debt in accordance with the legislation. US Co is an example of an inward investor. This is because it is a foreign entity with direct investments, the Australian branch, in Australia. The branch is the inward investor vehicle, as it is an Australian resident entity with a foreign controller, US Co. Therefore, this is a cross-border investment. We could also have an outward investor. This is when an Australian resident entity is either controlling a foreign resident entity or carrying on a business through an overseas permanent establishment. For example, a foreign subsidiary or an overseas branch. We need to remember that the outward investor rules take priority if the entity is also an inward investor, for example, foreign controlled. So that is, the debt attributable to the foreign permanent establishment is excluded from adjusted average debt, so that only Australian operations are subject to the thin capitalisation rules. So, as we have a cross-border investment, we now need to consider if the adjusted average debt exceeds the maximum allowable debt. The maximum allowable debt will be the greater of the safe harbour debt amount, arm's length debt amount, or the worldwide gearing debt amount, noting that some entities may not be eligible to use this last method. The second and third methods place the onus on the taxpayer to establish that either the debt financing is normal or that the Australian gearing does not exceed the ratio for the entire controlled group. In this clip, we are only going to consider the safe harbour debt amount. We should also remember that the maximum allowable debt and any exemptions will depend upon the category of investor. Financial institutions and authorised deposit-taking institutions, or ADIs, have higher maximum allowable debt due to the nature of their business. General investors will have different available methods to determine their maximum allowable debt depending upon their classification. So for this example, the first thing we will work out is the safe harbour debt amount. This is based upon a debt to equity ratio of 1.5 to 1. That is, that debt giving rise to Australian deductions should not exceed 60% of the average adjusted value of net assets. Firstly, we determine the average value of the Australian assets, in this case $56 million. For step 2, we subtract associate entity debt. This is amounts on lent to associates relating to the Australian permanent establishment, as these amounts will be TC tested in the associate. In this example, we have none. Then we subtract non-debt liabilities due to Australian assets, such as leave provisions and trade creditors. In this case, we subtract the $1 million leave provision. This gives us the net Australian assets that are funded by debt and equity. And finally, for step 4, we multiply by 60% to arrive at the safe harbour debt amount. We then need to consider the adjusted average debt for US Co, which is only the bank loan. So the adjusted average debt is $40 million. This debt exceeds the safe harbour debt amount of $33 million, and therefore the interest deductions must be scaled back from $3 million. The balance of interest deductions exceeding the $2.475 million is disallowed. There are exceptions, however, that we need to also consider. Thin capitalisation rules do not apply to annual debt deductions, including associates, not exceeding $2 million. Outward investor, non-foreign controlled, with 90% or more of assets located in Australia. That is, Australian entities with substantially all investments, including their associates, located in Australia, and entities without cross-border investments. To recap, thin capitalisation captures cross-border investments and applies to inward and outward investors where the taxpayer claims interest deductions against assessable income in Australia. The rules set out a maximum allowable debt which considers total worldwide debt financing their Australian operations. If the adjusted average debt exceeds the maximum allowable debt, then debt deductions, such as interest and financing charges, will be proportionately reduced.